Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us is Jeff Kilburg, Portfolio Manager and Chief Investment Officer with Sanctuary Wealth. Jeff, it's great to see you as always. Welcome back to Trade Talks as we wrap up the month of July on quite a strong note for stocks this week. And I guess the question is, should we proceed with caution considering some of the macro outliers that we still have to get through?
Well, Joe, it's a great question. It's actually a great month. And if you remember last time I was on, the last couple of times I've been on, I've been cautiously optimistic about the fact that we did see a bottom at that 3,600 level in the S&P 500. We've talked about how critical this week, arguably the most critical week of the summer. We had earnings. So many different earnings came out this week, but we also had the Fed meeting. The Fed meeting, they did a great job of really messaging, articulating what they were going to do. And the market really embraced the fact that we actually had data, GDP, and some folks can check the box and say we have 2 negative consecutive quarters, marking the fact that we're in a recession. So maybe the Fed does pause a little bit, take a breather. You actually saw the CME group Fed fund rates come down for the month of September. But what this really has done, it's allowed the technicals to take over. I talked a lot about the technicals last time I was on. We took over that 50-day moving average. And now, like that, we're back up to 4170. So I remain cautiously optimistic, but I think there's a lot of back and fill opportunity as we continue to understand this earnings season. But we have the ability, Jill, to really take in and look at Amazon today. Look at some of the mega cap names that have just been beaten out in so long due to the fact that the 10-year note moved from 1.5% to 3.5%. But lastly, I will say that guiding light, I talk a lot about fixed income. I cut my teeth, as you know, at the Chicago Board of Trade. And that 10-year note has been the guiding light. Now that's back under 2.7. That really has allowed some tranquility to come into the equity markets.
You know what? And Jeff, you read my mind because I was going to go there with you. Even though rates are going up, mortgages have been coming down, I think almost by 30 basis points, which is a lot in the mortgage space.
For sure.
It's because some bonds are higher and lower than others. Typically, they all move in fashion with the Fed, if I understand it correctly, but the one that the mortgage rate is dependent on is moving in a different way than others. How come some bonds are moving one way or the other?
Well, Jill, you hit the nail on the head. It's fascinating to see. We're actually seeing the correlation between stocks and bonds come back in line. And what happened in 2022? We saw a ton of velocity or torque that was built up in the treasury market. The 10-year note moved from 1.5% to 3.5%, and we saw equities sell off. Now we are seeing people still concerned and optimistic about the future. And that kind of dovetails into the fact that they're buying the long end of the curve. So the 10-year note has dropped, like you said, 80 basis points specific to the 10-year, which is giving some relief in the mortgage market. But I think it's finally getting back into a relationship where cats and dogs can live together here a little bit, Jill. But it's so fascinating to see that the fixed income markets, absolutely, we saw hellacious start the first 2 quarters. We saw the equities, the worst 2 quarters in quite some time. And here in the month of July, we're kind of normalizing. We're seeing this process. And this is all a function of the fact that we're in a midterm election year. I know I like to use history, and we can't really use history to the extent I want to, but for the last 85 years, Jill, we continue to see a ton of volatility in the first 2 and 3 quarters of a midterm election year. And that's where we're at.
Yeah. And you know what, Jeff, equally interesting is we saw the move in tech names, Apple, Amazon. It seems as if when they're reporting and they're giving their guidance, the trend is if it's not as bad as expected, stocks are getting rewarded. And I think when you talk about guidance and how they are formally announcing a shift in strategy to accommodate what's happening with the economy, whether it's freezing hiring or slashing back on spending money on growth for the following year, it's almost like the Band-Aid has come off. And we're going to, right. And I think that's what's key here is because it was anyone's guess. But now that management is shifting their strategy to come more in line with the macro environment, it seems to have calmed the market a bit.
Well, and to your point, every earnings season is nuanced. Some earnings seasons, we want to see the top and bottom beats. Those are really critical. Some earnings seasons, the forward guidance is not as important. But now, in the wake of the pandemic, as we're seeing China lockdowns come out, supply chain issues be relieved, I think that forward guidance is so important. And there's not a better example this earnings season than Microsoft. Microsoft, the initial miss on the top and bottom, we saw investors sell right after the market. And sure enough, once that rosy guidance, that forward guidance for 2023, which is forecasting, again, double-digit growth for Microsoft, you saw the absolute mega cap that it is turn around and go up 5% in that after-hour session. So I think you're spot on. That forward guidance is paramount, this forecasting kind of earnings season. But I think it's so relieving that we have the Fed meeting in the rearview mirror. We don't have a meeting in August. They've kind of signaled that they can kind of wait and hold. And they actually have some coverage now they technically have a recession with 2 consecutive negative GDP prints. They could come out and potentially pause or only do 25 basis points this September. And that's why equities are rejoicing. And you're also seeing the long end of the curve come down. So I think it's going to continue to be somewhat volatile, but we're shaping up to my very, very lonely view a couple of months ago that we're going to be even on the year. No one liked that. And now, of course, everyone's hopping on the bandwagon and talking. People are talking about 4,800 and further. But it will be interesting to see. I don't think we're walking away from volatility. I know the VIX and all the volatility measurements we utilize are not completely abating. But at the end of the day, I think we're in a pretty good spot because what we have focused on this earnings season and really understanding and digesting is that the economy is still profitable. We are still seeing these companies profitable. This recession or this pullback or this bear market was due to interest rates, not to profits.
Right. And Jeff, let's put on the advisor hat for a moment because you work with advisors all day long. But even if you were to come back to even and you think of it through the lens of a longer term investor, think of your 401k that had the opportunity to acquire shares at this valuation reset. You know, we thought about the pandemic drop off in the market as a generational gift. I mean, you know, the valuation reset we saw this year was another opportunity for investors to remain invested and acquire shares in their retirement accounts at such discounted levels. I mean, to get back from where we were to even is quite, a gain for many investors.
100%. And the advisors that I work with inside the Sanctuary Partner Firm Network, they did such a great job of rebalancing. We've really been focused. You know, one of the drums I've been beating at the end of 2021 and all of 2022 is this grappling or wrestling match between growth and value. So all my partner firms inside of Sanctuary Wealth have done a great job of making that adjustment, making that movement into value, but also the way we've owned the market. We've owned it in a very equal weighted manner, which has been a prevailing theme in 2022 versus that market cap weighted. So yes, if you're in qualified accounts or taxable accounts, having that rebalance, having that tax loss harvesting, which we've been doing all year, that should pay dividends and also allow for a potentially better outcome for these portfolios as we go into the holiday season. I can't believe I just said the holiday season, Jill.
Yep. And we are fortunate to have a number of these Sanctuary member firms on the show with us with all that great advice. Jeff, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.